Why do sellers care what type of financing you use? What does it matter to them? You're going to pay for their house, be it FHA, VA, conventional, or USDA. Why do sellers care? I'm going to tell you exactly why, specifically with FHA loans, the sellers do care what type of financing you're using. I'm going to give you the 5 reasons why some sellers may say no to FHA financing. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. Let's get right into it. I'm going to give you the top 5 reasons why in a multiple offer situation, and that's really important. We're right now in a seller's market. So in a seller's market, when sellers get multiple offers, if you're the only offer and you're FHA, they're likely to accept your offer. Or if there's only a few offers and you're FHA, they're likely to accept your offer. However, when there are multiple offers on a property and the property's in high demand, a lot of people want it, a lot of times FHA buyers are not looked at favorably. And I'm going to tell you exactly why. It has a lot to do with the risk of accepting your offer. So number 1, and probably the most important of the 5, is the amendatory clause. Let me say that again, amendatory clause, and I'm going to put it in the description as well as to exactly what it is. But every FHA loan, because FHA loans are backed by the government, include this clause. VA loans also include this clause. It basically says that the buyer does not have to purchase the house if the home does not appraise. Let me say that again. The amendatory clause in all FHA loans and all VA loans say the buyer does not have to purchase the home if the home does not appraise. They can terminate the contract and get their full earnest money back up until closing. So it doesn't expire. It's not a contingency that expires with FHA loans and VA loans. They can decide on the day of closing, it didn't appraise, I don't want to pay extra. They can terminate the contract and get their earnest money back. Even if you write and say, well, I'll pay the difference. You're able to say, well, if you don't want to pay the difference, you can change your mind. That is a huge, huge risk for a seller. On the seller's end, in the seller's market where several people may be bidding above the list price, FHA buyers have that out that conventional buyers don't have. Conventional buyers, they may have an appraisal contingency, but that appraisal contingency expires. So if they change their mind after that appraisal, if they have an appraisal contingency in their contract, if they change their mind after the appraisal contingency expires, the seller gets to keep their earnest money as damages. They cannot do that for FHA and VA loans. So that's the number 1 reason that there's a higher risk to accept an FHA offer over a conventional offer. Let's go to number 2, the 90-day rule. I know if you're an FHA buyer, you might have seen homes on sale, especially that investors have recently flipped, that companies like Open Door or OfferPad or Zillow have bought homes and put them back on the market. A lot of them are not eligible for FHA financing because FHA has a 90-day rule that the seller has had to own the property for at least 90 days before they can sell it to somebody else, before they can sell it to an FHA buyer. They have to have owned it for 90 days, and that FHA buyer cannot make an offer on that property until day 91. So it takes you out of the market for some of those homes that have been recently flipped, that you cannot purchase them until those 90 days have gone. Okay, that's number 2. Number 3, FHA required repairs. Now, to me, in my experience, they have not asked for really serious things on homes that were in decent condition. If a home needs a lot of repairs, like a rehab, it's probably not going to be FHA eligible. But in other homes where the home is in reasonably good condition, FHA will ask them to fix some things that maybe a conventional loan will not have to have them repair before closing. So some sellers are scared, depending on the condition of their property, that FHA is going to require repairs as and they're going to tie that into the appraisal, basically saying that you have to fix this in order for the appraisal to be, approved. You have to go ahead and fix these things first. So there are some FHA required repairs that some sellers may try to avoid. But for a lot of my first time home buyers, we're not looking at homes that need a lot of repairs because, you don't, as a first time home buyer, you don't want to get into a situation where a property needs a lot of repairs. Okay, that's number 3. Number 4 is that the FHA appraisal stays with the property for 120 days. So if a seller does accept an FHA offer and that property appraises or doesn't appraise, and for some reason that deal terminates, that appraisal, that FHA appraisal, stays with the property for 120 days. So if another buyer comes along, maybe another FHA buyer comes along and they want to pay more or something like that, that appraisal will still be the same. Even if the house is worth more later, they could say, okay, that FHA appraisal is still valid for 4 months on that property if they try to sell it to somebody else that's also an FHA borrower. They can sell it to a conventional borrower, and the conventional borrower will do a different appraisal. So conventional, if you take a conventional offer and it gets appraised and the deal terminates, then that appraisal also goes away. You sell it to another conventional buyer and then they do another appraisal. For FHA, that appraisal stays with the property for 120 days. So a lot of sellers don't like that appraisal is going to be there for 120 days. And the last one that I think is more of a perception than reality, sometimes it's reality, is that FHA buyers are less financially able to purchase. And it is easier in most instances because of the criteria. A lot of times it's easier to qualify for FHA financing than it is to qualify for conventional financing. So there's a perception, whether it's fair or not. Not always the case. A lot of people, sometimes the FHA interest rate might be lower. There's a lot of other reasons why somebody might do FHA financing, then they just couldn't qualify for conventional. But I think the perception is there that because FHA loans have more lenient standards as far as qualifying, credit score wise and DTI ratio wise, that the buyer may be less financially able or stable. Okay, so those are the top 5 reasons why somebody would maybe not take FHA finance. But I still close the majority of FHA buyers. This is what they've had to do in this market, in the seller's market, if there are multiple offers in order to compete. So they've had to offer to cover the gap. So if they are bidding above list price and the seller may think, well, it may not appraise for this higher price, they are offering to cover some of that gap. Not the entire appraisal, because we don't know what the appraisal is going to come in at some point, but at least a portion of it that they're comfortable with, that they can budget to say, okay, we're willing to pay this above the appraised value if the property does not appraise, not to exceed a certain amount. So they are offering to cover the gap. They are going to new construction. New construction typically doesn't care that you're doing FHA or conventional, unless, new construction has gotten a lot more competitive lately as well, but for the most part, new construction will take FHA without a problem. Another thing you can do is offer options money. It's basically, options money is you paying the seller directly to accept your offer, and they get to keep it separate from earnest money. They get to keep that money as just like, extra money because you accepted their offer. The other one is showing proof of funds. So if they don't think that you are as strong maybe as a conventional buyer, maybe you show them proof of funds with your pre-approval letter showing that you are financially able to purchase. The other thing is conventional does have a 3% down payment option. So you may want to look into the 3% that does have income caps on the 3% conventional. So sometimes it works for some people and sometimes it doesn't. And lastly, Ribbon. So Ribbon is something, it's regional, but Ribbon is a company that turns your your offer into a cash offer. Basically, they put up their cash so you can get your offer approved, and then you can get it financed, or they can buy it cash. They give you multiple options. But I'm going to put a link to that down below as well, because although I believe it's regional, Ribbon may only be in the South, the Southeast. There are probably companies like Ribbon throughout the United States. I'm just not that familiar with them. But basically, it allows you to buy, kind of compete with the investors, compete with some of the conventional borrowers to turn your offer into cash. I hope this was helpful for you to know just why does the seller even care what kind of financing you're using, to help you think about and strategize with your agent to put in strong an offer as you're able to in this competitive market. If you have any questions, please put in the comments. If you haven't already, please like and subscribe to my channel for new videos every week.